Welcome back. Today on the Byte-Size Brief, we're going deep on DigitalOcean, ticker symbol DOCN. If you've been watching the markets lately, you realize we're in this bizarre, almost whiplash-inducing environment for tech stocks. We are literally witnessing a massive fundamental shift in how the market values enterprise software now that we're in the AI era. And right at the absolute epicenter of this shift is DigitalOcean. They're a mid-cap developer cloud pulling off what is frankly one of the most fascinating strategic pivots we've seen all year.
So let's just look at the sheer contrast here. We are navigating what analysts are starting to call the SaaS apocalypse. The IGV software ETF, which tracks the broader software sector, is in a brutal bear market right now, down about 24% year to date. We're talking about incredibly strong companies seeing their valuations just get absolutely crushed. Yet inexplicably, DigitalOcean is sitting on a 12% gain year to date. So how is this little developer cloud thriving and pushing upward while the rest of the software sector is basically bleeding out? Well, that's exactly what this explainer is going to uncover.
Here's our agenda for today. 1. The SaaS Apocalypse Survivor. 2. Renting the race car. 3. Q1 2026 AI inflection. 4. The bull case accelerating. 5. The bear case, high risks. And 6. Future roadmap to watch. Section 1. The SaaS Apocalypse Survivor, defying the software crash.
Think about it like this. For the last decade, the entire software industry was basically built on a per-seat business model. You hire 10 customer service reps, you buy 10 software licenses. It's simple, right? But suddenly, AI agents can step in and do the work of those 10 reps. And if you only need one human, well, you only need one software seat. That realization alone is crashing traditional SaaS valuations. But contrast that with consumption-based infrastructure. AI doesn't buy software seats, but it voraciously consumes computing power, storage, and networking. And DigitalOcean sells that exact infrastructure.
The scale of this shift is honestly staggering. Nearly $1 trillion in enterprise software market value has been completely erased in recent months. $1 trillion. The market isn't just taking profits here, it is fundamentally repricing the terminal value of seat-based businesses. Yet because DigitalOcean is sitting on the consumption side of the AI divide, they aren't just surviving, they're genuinely thriving. Up 12% year-to-date, boasting incredibly healthy 42% EBITDA margins. They're proving that profitable growth is absolutely still possible, you just have to be standing on the right side of the AI revolution.
Section 2. Renting the race car, how DOCN actually makes money.
Okay, so what's really interesting here is this specific term, Agentic Inference Cloud. Now, DigitalOcean used to be known mostly as a simple web hosting service for hobbyists and solo developers, but they've aggressively rebuilt themselves. Today, they're a full-stack platform for digital native businesses. They aren't just giving you raw server space anymore. They're handing you the integrated infrastructure, the data layers, and the managed agents you actually need to run AI models out in the real world.
To really grasp their specific niche in this AI boom, think of it like this. The giant hyperscalers, your Amazons, Microsofts, Googles, they are fighting a literal billion-dollar war to train AI. Training foundational models is kind of like building a custom multi-billion-dollar race car engine. It's incredibly expensive, incredibly complex. But DigitalOcean, they're smart enough not to fight that war. Instead, they focus entirely on inference. Inference is the act of actually using the AI model to do everyday work. It's like driving that fancy race car to the grocery store. It is a vastly larger market by sheer volume, and it's where everyday small and medium businesses actually operate.
By focusing strictly on inference, DigitalOcean has carved out this massive, highly defensive moat. Their whole value proposition boils down to developer-first simplicity. Look, if you're a startup, logging into AWS can feel like staring at the control panel of a nuclear submarine, and the pricing is completely opaque. DigitalOcean, on the other hand, offers predictable pricing with zero bill shock. By catering to SMBs and open-source AI models, they've locked in a fiercely loyal community of over 640,000 customers who actively want to avoid the complexity and the massive fees of those giant hyperscalers.
Section 3. Q1 2026 AI inflection.
Now, this strategic pivot sounds amazing in theory, right? But the market always demands proof. And that brings us to the explosive Q1 earnings report that just dropped on May 5th. This was the moment the market realized, oh wow, the pivot is actually working. And here is the headline number, $258 million in Q1 revenue. That represents a 22% year-over-year growth that completely shattered analyst expectations. In a quarter where other cloud players were guiding down, DigitalOcean proved that demand for their specific flavor of AI infrastructure is literally accelerating.
But the really crucial point lies right beneath the surface.
While overall revenue grew a very healthy 22%, their million-plus-dollar customer annual recurring revenue, basically their biggest, most demanding clients, surged 179%, and their AI customer AR, an absolutely jaw-dropping 221% surge, bringing that specific segment to $170 million. This proves decisively that they aren't just picking up low-value hobbyists anymore. They are rapidly migrating high-value customers into highly profitable AI inference workloads.
Capitalizing on all this momentum, back in April 2026, they hosted their Deploy 2026 event. This is where they fully unveiled their AI-native cloud. And this wasn't just some marketing rebrand. It included over 15 integrated product launches. Thanks to their recent acquisition of Catanamo Labs, they added agentic AI primitives directly into their stack. Plus, they integrated top-tier NVIDIA and AMD GPUs, proving they've got the actual physical hardware to back up their software ambitions.
Section 4. The bull case, accelerating fundamentals.
When we objectively look at the fresh data, the argument for continued upside is incredibly compelling. First, management is so confident that they actually raised their full-year 2026 revenue guidance to $1.09 billion. That signals accelerating growth in a really tough macro environment. Second, and maybe a most impressive stat, they reported 0% churn among their million-dollar-plus clients. Zero. Not a single top-tier customer left the platform. That is extreme stickiness. And finally, they've added 60 megawatts of committed data center capacity to future-proof their operations against this incoming AI demand.
To actually fund that 60 megawatts, DigitalOcean executed an $888 million equity raise in late March. Now, normally the market hates dilution, right? But in this case, it's basically a strategic weapon. They used part of it to pay down debt, de-risking their balance sheet, and deployed the rest to secure the physical data centers and GPUs they'll need through 2027. They're quite literally spending money to make money, making sure they aren't capacity constrained when all these SMBs come knocking for inference workloads.
Section 5. The bear case, high risks at high prices.
Look, when a stock runs up as fast as DigitalOcean has, the air gets really thin and the risks become highly magnified. As an explainer, it's our job to look at the whole board impartially. So let's look at this crucial red flag. While the stock has surged over 81% in just the last 6 months, executive leadership has been cashing out. CFO Matt Steinfort sold about $1.1 million in stock, Senior VP Sherry Barrett sold roughly $1.2 million, and most notably, total insider purchases in the last 6 months? 0. When executives are selling into a rally and absolutely no one inside is buying, it definitely suggests management might believe the near-term upside is already fully priced in. Furthermore, there are some real structural vulnerabilities here. The stock's valuation is heavily extended right now, meaning any slight miss in future earnings could trigger a really sharp sell-off. Secondly, their core customer base, SMBs and startups, they're notoriously sensitive to macroeconomic slowdowns. If venture capital dries up, those cloud budgets are going to be the very first thing to get slashed. And finally, we have the ultimate existential threat, the hyperscalers.
Ask yourself this very specific scenario. What happens if Amazon Web Services decides to aggressively slash prices on their custom AI chips like Trainium or their managed service SageMaker? DigitalOcean is spending hundreds of millions right now to build out infrastructure. If the giant hyperscalers decide to commoditize AI inference and trigger a race to the bottom on pricing, DigitalOcean's margins could face severe, violent compression. Their motive simplicity might not actually survive a brutal price war.
Section 6. Future Roadmap to Watch.
Whether you lean bullish or bearish, there are concrete catalysts you need to monitor over the next 12 months. The immediate stress test comes in Q2 2026. The market is going to be watching like a hawk to see if that 200+% AI ARR growth was just a one-time spike, or if it's durable momentum. Moving into Q3, we really need to see if their new Catanamo Labs agentic AI tools can actually attract Fortune 500 evaluation cycles, proving they can successfully move up market. And looking toward 2027, the deployment of that 60 megawatts of capacity will either be a massive revenue driver or a really costly albatross if utilization rates drop.
I want to leave you with this quote from CEO Paddy Srinivasan. He called their recent moves the most significant product launch in our history. Let the magnitude of that really sink in. DigitalOcean has fundamentally burned its old boats. They are no longer just a cheap place to host a hobby website. They have literally bet the entire future of their multi-billion-dollar company on becoming the primary AI inference engine for the digital native economy. Which leaves us with the ultimate question. Will this scrappy underdog successfully navigate the SaaS apocalypse and cement its place as the definitive AI cloud for SMBs? Or will the trillion-dollar hyperscalers eventually wake up and crash the party? That wraps up today's deep dive on DigitalOcean, DOCN. For a sharper, more candid discussion, join us on the full audio podcast. Drop your questions and takes in the comments. We read every one. See you next time.